Good afternoon. Welcome. Thank you all for being here today. We are broadcasting live from Park City, Utah, where I am. And Jeff, you're in San Francisco.
Yep.
San Francisco
Correct.
area. We are excited and we're welcoming back Jeff. We've been the beneficiaries of having him a few times, and we're anxious to hear an update, and not only that, but hear more about what's going on with Right Side Capital. As usual, we can't see or hear you. We know you're there. If someone wouldn't mind just pinging and make sure we're broadcasting properly, just saying hello, that would be great. Even though we can't see or hear you, we welcome questions, and please post them in the Q&A or the chat box as they come to mind. We have quite a few people joining today, but we'll get to as many questions as we can. For the record, this is being recorded and it'll be posted on the Family Office Insights YouTube channel in a couple of days. And also, if there's anybody that, as you see the presentation today, it comes to mind that would benefit from meeting Jeff and understanding the Right Side Capital story, you're welcome to do that. And we will make sure that you're connected directly with Jeff and Right Side Capital. So again, we're so happy to have you here, and thank you all to the Family Office Insights community for slogging through all this non-in-person webinar stuff. I'm delighted to announce that we're back doing in-person gigs in New York City. We've had 2 so far. I just came back from New York. Things are mostly normal. Just don't go to Penn Station. So again, thank you all for being here. And with that, Jeff, welcome once again.
Thanks, Arthur, and thanks everybody for joining. I am Jeff Pomeranz of Right Side Capital Management, one of the managing directors here. I have 2 partners. We've been working together for 12 years now. We launched our first fund in early 2012, and we are known as one of the most active pre-VC stage tech investors here in North America. I'm going to share the screen now. Bear with me for a moment while I get this up. Okay, can you see that, Arthur?
You can see it. It's gonna go right into with the little lag that we had. Let's see if it populates. There you go. Perfect.
Okay,
you're all set.
Great. Got it. So I get one just disclosure. I'm not going to read through this thing, but we do talk a lot about some tax benefits we take advantage of. Just to be really clear, some of these tax breaks that we, as with other, early investors like angels and founders, can take advantage of, referred to as qualified small business stock rule. They are currently being proposed in the budget package in Congress now to be altered. I do not know if that's going to go through as proposed, but if it does go through as currently worded, it would reduce the benefit. It wouldn't get rid of it, but it would reduce it. Still better than capital gains, but not quite as good as it has been. Anyway, the information in here is based upon the current rules. Okay, so so we have, over the years now since we launched, we have invested in over 1,200 tech startups here in North America, most of the US, but we do some in Canada as well. We manage 6 funds with 2 distinct strategies. I'm going to be talking today, for the most part, about what we think of as our core strategy. We have currently managing 4 funds, RSCM funds 1 through 4, with this strategy, and we are launching Fund 5 next month. That's what we are currently fundraising for and accepting new investors for right now. So all of our funds have the goals of providing consistent, repeatable and very high returns in a range of returns that we feel we can deliver 3 to 5x net to our investors, sort of regardless of macro environment that we might end up with over the years. And that's an important part of it, because we are designing the strategy to also protect the downside and minimize volatility. We do that largely through massive diversification, which I'll get to. And secondly, we are optimizing everything we do to take advantage of these tax breaks that are available to early investors like us. Let me spend a few minutes talking about what I mean by the pre-VC market. We used to call ourselves pre-seed, but that's come to mean something definitively different and later than us. So we've now been calling ourselves the stage we invest at pre-VC. This is usually companies only looking for $100 to $400, $500,000. Today, the companies usually have a live product. They've got some early customers. They've got some small revenues. And as we'll talk more about later, this has been an ever increasing body of tech companies. There's been more and more companies, because of the capital efficiency of tech companies, looking for these small tranches of capital. But what hasn't really happened is there's been no new body of investors really move in to fill that demand, because the amounts of capital that the companies are looking for is really just too small for the venture industry at large to bother dealing with. It doesn't make sense for them to spend what's normally weeks, if not really months of time, vetting companies that are only looking for a few $100,000. They'll simply wait until the company is ready to raise larger $1 to $3 million plus seed rounds. Now, that presents a big opportunity for us. I mean, there are two main reasons why we address this end of the market. Number one is the returns are higher. So always been that way. It's nothing new. The returns are higher the earlier you go, for a bunch of reasons, but the main one is that the risks are higher. Most startups fail. And but the second thing that is more newly evolved is this lack of professional competition. We get to make offers to companies in a environment where there's really no competing offers. Obviously, that plays to our benefit. So we build funds that where 100% of the capital is targeting companies at this stage of the market, where the round sizes are too small for VCs to address. We're exploiting all these inefficiencies to generate consistent, repeatable, high returns at a fund level, and optimizing for the tax efficiency to minimize the tax impact and any gains that our investors need to pay. So how do we go about doing this? Our solution for it, to address the challenges, which is these high risks at this stage, most startups fail. It's a really inefficient end of the market. We wanted to protect the downside and lock in the ability to capture these high returns. We developed a data-driven set of processes, a strategy that will utilize the objective data on a company rather than subjective, gut feel and opinion. And by doing that, by utilizing just the raw data and the things like the team of, the aggregate skill sets of the founding team, the business model, the traction and revenue a company has. We're looking at these data points, and that allows us to make really fast decisions, and it reduces the time needed to make decisions by, we estimate, 95%. Now that has two big outcomes that benefit us tremendously. Number one, it can allow us to make large numbers of investments. But even before that, build out these portfolios with exposure to many hundreds of companies. So our funds, our last couple of funds, each had over 600 companies in it. The second thing, though, from the startup's point of view, is an equally beneficial effect. We can now deliver a yes or no to these founders, usually in days, and capital within weeks. That compares to what the norm is, which is usually closing rounds in months. And for founders, that's an extremely distracting process. Time is critical to founders, and they will bend over backwards, and essentially they're more than happy to take a smaller amount of money at a much lower valuation if they can get that money more quickly, because they can put that money to work instantly to build out whatever it is they're trying to build out and increase their growth. So, but the other side of it here is most importantly, we can then build these massively diversified portfolios that can then lock in the returns that are inherent within this end of the market. Let me touch on the capital efficiency stuff for a moment here. I'm not going to go into the details of all the nuances of these tax breaks, but I'll touch on them briefly. Most of the gains that come from our funds, we expect to qualify for the qualified small business stock exemption. This is Rule 1202. And that exemption allows, as of today anyway, the gains to be exempt from capital gains federally and in most states. The second rule is called 1244, and that has to do with how losses are treated. For 1244 qualified losses, because remember, lots of our companies fail, and that's a loss, but instead of that it being a capital loss, a lot of that can be used against ordinary income, so it can be used to greater effect. The main things that need to qualify for QSBS tax exemption is it has to be a US C Corp. You have to be invested very early in the stage of a company prior to them having gross assets of 50 million. And you have to have held it for 5 years as equity before that potential event, like an acquisition or sale of the stock. You also need to be buying the stock directly. You can't buy it from somebody else, okay, in a secondary market or something. There are a bunch of other things as well. Those are the main ones. And again, if it qualifies for these things, and most of our biggest gains are on companies we've held for 5 years or more, almost everything's a C Corp, and we're invested in early enough in everything. It means we're passing through on the K1 those gains tax-free federally and in 45 of 50 states. Not here in California where I am, but most other states. I already touched on the 1244 losses, so I won't bother going into the detail there. Anybody that wants more detail on this stuff, in the deck I'm happy to share with you, we have an appendix that goes into more detail there. Okay, let me talk about the history and performance for a moment. The detail on this page is the information on our first fund, which we launched in 2012, and it's data through Q2 of this year. We launched the fund in Q1 of 2012. We invested the capital over a 3-year period of time. So those in the 279 companies spread out over 2012, 13, and 14. Through Q2 now, we have a net multiple, or TVPI, at 6.2x. And we've distributed about 175% of that. That equates to a 26% IRR. Now, including current timeframe, so through October now, I'll just mention it because we have now sold a couple of our largest positions. We now are in the end phase of this fund. We're 9.5 years in, and we will be looking to wind this fund down next year. So we're selling assets that have grown to be substantial in this fund. We've now distributed just under 6x distributed to our investors, with another 1.5 to 2x still remaining in the fund. So clearly, this fund now has actually wildly outperformed our goals, and that's been we've benefited tremendously from quite a number of factors. The tax effect here for our investors. So this data on the bottom part here is just taken directly from the K1s in aggregate through 2020. Okay, to be clear, we don't have 2021 K1s yet. So for an investor in our first fund, $1 million commitment, they actually paid in $930,000 because we actually had a liquidity event in year 3 that offset some of their capital calls. We distributed a little under $1.5 million back to investors through the first 8 years. And most of those distributions were qualified gains. That's what that next number is, the 1.192 million. That's the stuff that was QSBS qualified, therefore no federal tax. The next 2 lines are aggregating all the other stuff, the stuff that was taxable, and then you aggregate all the different losses and other deductions that you can pass through to on the K1 to our investors. The net of all of that is actually an effective negative tax or tax refund. It's not literally, you're not getting a check back from the IRS. It's just more losses that you can use against other gains in your portfolios and things like that. Because so much of what we were able to distribute were qualifying gains.
Hey, Jeff.
Yeah.
If it's okay,
Sure.
Since we talked about losses here, of those 279, how many survived?
Yeah, so currently about 60% of the companies are still operational in the fund or have exited for a positive exit. So on the flip side, 40% of the companies are write-offs, they're zeros. And then 60% are still operating. Now, yes, plenty of those 60% are, going sideways or not doing much. They're not really that productive, but there's still a lot of good assets there. Like all venture capital, it's all about the top 5%, the top couple dozen companies in there. But I will note, you brought up a good question here. Survivability is a very important part of what we focus on. And that's part of the reason why we focus so much on capital efficiency. And the idea that you can't necessarily know which ones are going to be the big winners. The more you can keep in play for a longer period of time, the more that you give them the chance to figure things out, and some of them figure things out and actually take off. So 60% is much higher than we had originally modeled in. Now, obviously, we do a lot of things to increase survivability of our companies. It's just worked even better than we had originally modeled in.
Yeah. So to oversimplify this, and I'll help you with the disclosure, not giving tax advice.
Yeah.
Essentially, it's idiosyncratically a function of your own tax situation. But in this example, you basically took all your gains tax-free and had a net loss that could offset other taxable income.
Correct.
Yeah.
Now, I don't want to give the people the idea that that's the way it will always work with all of our future funds. There are some changes in the tax code from a few years ago that reduce the amount of deductions we can take. Things like management fees and other deductions in funds are no longer tax deductible. So there's not quite as much in losses to pass through. And most importantly, these QSBS rules can always change. Whether they change based upon the current budget proposal or not, they can change in the future.
Right.
I can say that there's plenty of lobbying pushback against changing them. These are rules to incent, at-risk investments for job creation. That's why they were created. But all I know is that the rules still exist, and at worst, if they are changed based on current rules, they'll still be a lot better than paying capital gains. They just might not be as great as they are today.
Right. And having said that, if this was just a capital gain taxable situation, it's still super attractive.
Yeah, worst case capital gains are almost all of it.
Yeah.
98% of it's going to be long-term capital gains.
Got it. Great. Thanks.
Yeah. Okay, so let's jump to our other funds. So this chart is showing the blue line is our first fund, which we just talked about at 9.5 years in. The orange line is our fund 2, which is now 6.5 years in. We launched in the beginning of 2015. And the green line is our third fund, which we launched in mid 2017. So it's 4 years in. I don't have fund 4 on here because it's only just, it hasn't even finished its investment period. So it's just going to show a flattish line like you see in the first couple of years of all of our funds. So it doesn't add any value. A couple things to note here. First of all of our funds you can see sort of follow the same profile. There's not much volatility of ups and downs. They tend to just go up a bit every quarter, just depends on how much. More importantly, though, this is a good visual to see how Fund 2 and Fund 3 are clearly ahead of our first fund, and Fund 3 is ahead of Funds 1 and 2 at their respective points in their life. Now, there's a lot of reasons for that, but the main reason is because this capital efficiency trend that I keep talking about has gotten more extreme since we started in 2012. So this capital efficiency I'm talking about, this is the cost to build tech. Technology costs come down every year. That's nothing new. The part that's new is that it's come down so far that the amounts of capital companies are looking for is simply too small for the venture industry to bother addressing. But what we benefit from year over year is simply that companies are further along before they're looking for that first outside capital from people like us. So companies are progressively have more traction or more revenue. But what hasn't changed is that because of this lack of professional competition, because of the lack of investors dealing with this end of the market, valuations have remained very stable or have actually gone down. And let me dig into that a little bit more because it has a profound effect on performance at the end of the day. Our first fund, and I think I have the page in here. Yeah. So our first fund largely invested, I'll get to this in a second, largely invested in pre-revenue companies, because at the time, you can see that on the left, RSCM Fund 1, the median monthly revenue at investment was 0. They didn't have a product yet some of the time even. And you can see on the right is the median valuation at which we invested into these companies, $2.5 million in our first fund. So because companies in 2012 and 13, when they were looking for first outside capital, they still mostly needed a year or more and 500 grand or so to get that first product built and out to market to see if companies wanted it and wanted to pay for it. By the time Fund 2 came along, we now were looking at maybe 50-50, but I'd say a little bit more in the majority of times, companies actually had some revenue. And the average, the median revenue at our companies that invested now crept up to about $7,000 of monthly revenue. But we still were paying the same average valuation. And then you go to Fund 3, it got a little bit more dramatic. Now the median valuation is $12,500. Still, we're paying $2.5 million for that. So think of that. There's basically a flat valuation curve and an increasing level of traction year over year. So for any 1 or 2 companies, it doesn't necessarily matter because those can be anomalies. But when you're looking at a pool of 600 companies, which pool would you rather own? The pool of companies that are pre-revenue that you're paying $2.5 million for, or the pool of companies with $10,000 to $15,000 of revenue that you're paying the same price for? So for the same price, we're getting less risk is another way to look at it. We no longer have as many companies failing in the first year or two because they never even get a product off the ground that anyone cares about. And then you can see in Fund 4, which has been investing just for a year and a half now. The revenue has jumped up again, and so far the valuation has crept up a little bit, not much. So that just has a profound effect on performance at the end of the day. Now, one other point, just with the current environment, our current investing not only has this positive trend we're taking advantage of, but now we've got this post-COVID disrupted world, and venture as a whole always benefits from that. Disruption is good. It shakes things up, shakes up competition. When you're small and nimble and early in a company's life, you can adapt and pivot more quickly, attack competitors more easily, take advantage of some of these new territories that weren't really, like remote education. No one really thought much about it 3 years ago. Now it's a huge area. Remote HR, massive area right now. No one was really caring about it a few years ago. So a couple of our more notable exits here. I'm not going to go through them all, but we did DigitalOcean here, was an IPO in March. TradingView has been one of our biggest exits. This data is through Q2 still, so that isn't reflecting some of our recent sales. What's important here is we're getting very large multiples on our exits because we're invested at $2 to $3 million valuations. Amazon bought PillPack for $1 billion. That was an 80x return for us after massive dilution. DigitalOcean, with this 108x return was as of Q2. We sold a last piece of it. We had one piece of it still remaining after the IPO because we'd had a couple of exits. We'd sold some pieces of it in the secondary market along the way. That was at 1,000x. That remaining piece was at 1,000x multiple. So massive multiples when we get to that final exit point because we're in at such low valuations. Just a note on the three of us, we've all been working together since day one here. I come from the financial services industry, started in the early 90s at Smith Barney on the wealth management side. My first startup was a brokerage firm. We were a technology research boutique, sell-side research. We catered to the hedge fund community. My two partners, Dave and Kevin, they're the tech guys. They went to Stanford undergrad together and both had separate careers as tech startups, guys in the Bay Area here, multiple companies, multiple exits. Let me touch on a couple of the nuts and bolts sides of things of how the funds work for those of you that might not be familiar with limited partnership structures, venture fund structures, and capital call structures. So for any of our investors, this fund will launch in December of next month. It will get exposure over the following roughly 2 years into 600 plus companies. So we're going to be investing that capital pretty steadily over the next couple of years. Now, our funds all have, the benefits are obvious, high net returns, more predictability, repeatable returns, all that kind of stuff, low tax. The sacrifice people make in going into funds like ours is it is illiquid and it takes a while to play out. It's back end weighted, like you saw in our first fund. It's year 9. That's when all the big money starts really coming out, years 8 through 10. So you're not expected to get much back in the first 4 to 6 years. The larger distributions are all coming back years 7 through 10 in the fund. I'll touch on, I'm not going to go into details here, but just in full disclosure, so you're aware of it. Our second strategy is under the branding of Peregrine Select. We have 2 funds currently. We did a Peregrine Select 1 in 2018, and we launched a Peregrine Select 2 in earlier this year, which we're actually still raising. What we're doing in this strategy is we're cherry picking extraordinary opportunities out of our huge portfolio of existing and evolving tech companies. So we're tracking these companies in our funds, we're monitoring them, and obviously there's all sorts of situations where companies hit inflection points or they just have opportunities we can really take advantage of. In addition to that, we have identified another sort of crack in the whole startup venture capital ecosystem that's not really addressed well. And we categorize it as a segment of founders where they're not able to really get what they want from the venture community. The venture product as a whole is pretty homogenous, tends to offer pretty standard types of funding rounds and operational trajectories to the companies, which is fine for most companies. In other words, they're usually looking at funding rounds that are, whether it's a seed, A, B round, 20, 25% of the cap table. They want companies on high growth, high cash burn trajectories, shooting for huge exits. Again, this is fine for most companies. There are a certain number of founders, though, that actually don't necessarily want that. They want to actually at least have the option to sell their company in a couple of years, few years, if it happens, at a sub $200 million exit. Well, Series A round venture investors, they typically don't want that. They're going to block that kind of an exit. Sometimes companies want to get cash flow positive, God forbid. They want to grow a little bit more organically and not have a huge cash burn. The point is, there is a niche here of an ability for us to actually be flexible and offer to founders what they're looking for: flexible round sizes, more control over their operational trajectory, fundraising trajectory, exit options, et cetera. In an exchange, we're able to get capital invested into some of our additional capital invested into some of our best companies at significantly discounted valuations comparative to what they'd be able to get on the open market. And then we structure the fund as a more concentrated portfolio. So this will be 25 to 30 companies, 250 to $1.5 million checks. So it's a different profile of returns, different stage of the market, capitalizing on our essentially our data and inside information we have on our portfolios. Lastly, here on our Fund 5. So it's a fairly typical venture structure. We are collecting docs right now. We are going to be accepting new investors until we get to 30 or 35 million in capacity in the fund. We're going to cap the capacity of this fund because we are investing in it over a relatively short period of time, just the next 2 years. And at latest, this would be January or February. So this is a fairly short fundraise. We have a 2% management fee. That's the average over the life of the fund. We have a 20% carried interest or performance fee that we only take after investors have received back their paid-in capital, their investment in cash distributions, plus a 5% cumulative preferred hurdle rate. So that's the nuts and bolts on the structure. Anybody that has interest in getting more information, obviously reach out, email me or call me. Happy to share the deck, happy to go into as much detail as you want. I'll touch on just a minimum investment. The standard minimum commitment is 500,000. It's a capital call structure, so about half of that's going to be called initially, and the balance will be over the next 18 months. We do have flexibility to go a bit lower than that during the December during the first close. Okay, I'll pause there and take it off a screen share for any questions.
Jeff, the chart that you showed about the monthly revenue rising and the valuation staying pretty consistent, are you still investing in companies that are pre-revenue in Fund 5?
Yeah, so good question. Yes, we still will look at pre-revenue companies. It's much more seldom because we just don't need to. But I'll say this, a pre-revenue company in Fund 1 was a $2.5 million median valuation. A pre-revenue company today is usually around more like a $1.5 million valuation. And that's a big deal. in an environment where, and until you understand that supply and demand imbalance of what's going on at this end of the market, where you have more companies than ever looking for these tranches of capital that are so small, but no one's really providing them. None of this makes sense, because the valuation we are investing at is lower today than it was 7 years ago. Every other stage of venture capital, it's the opposite. Where the value, well, I should include another chart here showing Series Seed A, B round, right? I mean, but everyone knows it's done nothing but go up in valuation every year. And it's all because the opposite has happened. There are, I've heard numbers of more than 6,000 or 7,000 new seed and pre-seed stage venture funds have been started in the past 5 to 10 years. There are thousands of investors that will address that end of the market. So so obviously, huge amounts of capital are chasing the deals, valuation goes up. No one cares about companies that are only looking for 300 grand and might be in Austin or Chicago or San Diego.
And the checks that you're writing out of Fund 5 now, are they 50,000, 250,000, 300,000? It's probably not really a fair question, but.
No, it's fine. I mean, yes to all of that. We have ways of doing this so that we can do as little as, $20,000 or $30,000 all the way to 200, 250 or so. There is an upward limit here because, again, these are companies looking for small rounds. We can't start investing 500,000 or more into companies, because then we'd be creeping into the stage where everybody is competing. We're not going to do that. So it's most of the time it's $50,000 to $200,000 we are investing into companies looking for $300,000 to $500,000 in total.
So we have let's get some questions. What's the typical criteria for companies you invest in, and are there specific sectors? Also, do you do follow-on investment? And I think you answered part of that with the Peregrine, but.
Yeah. So yes, on the last part first, we do not do any follow-on investing in our core strategy. So it's 100% single one-time checks into these hundreds of companies. But that's why I sort of like to include at least that disclosure of the Peregrine, because that fund does effectively invest into existing portfolio companies later on. It's not usually not the next round. It's usually 1 or 2 rounds later, 1 to 3 years later in the life cycle of the company. On the first question, we are 100% tech investors, but we're agnostic as to what kind of tech vertical, as long as it's a capital efficient tech business. So it tends to look more like software and services. It's not going to be things generally that have physical products, manufacturing, inventory, not things that are R&D, science kind of projects that take years to figure out. No commentary about that being a good or bad business, just more capital intensive. And we're focusing on the capital efficient industries.
Let's look at, hey, Anthony, nice to see you here. Do you diversify sector, industry, or not? Are companies based globally or US? Do you focus on a particular sector? So you answered part of that, but.
Yeah, so yes, diversification is a core part of our entire strategy at every level we can think of. So yes, we have within capital efficient tech, we are going to prioritize diversification in, barring a couple categories, any kind of capital efficient tech vertical. We're going to be diversified geographically all over the US, in Canada. We always have had a bias for secondary and tertiary geographies, which basically means not Silicon Valley and New York to some extent. We still do plenty there, but we love companies from all sorts of other cities, because as you're
smart people everywhere.
When you're a startup, you don't need to be in San Francisco. You can be anywhere. And your operating costs are going to be a fraction of what they are here.
So I'm going to say something on your behalf, and you can tell me whether I'm wrong. So in the case that some of the people in the audience might have companies that are interesting to you, I would ask them to go to the website and apply officially. In the case where there's a potential investment, they can contact you directly. And I'm just trying to save your time. That's all.
Yeah. Yep.
Uh,
Exactly. We're extremely transparent to any startup. If you go to anybody that wants to share a company with us, that's great. We welcome that. Go to our website. There's under the submit tab, we have a couple pages of information on exactly what we're looking for. So if you then do think it fits, then it's, follow the instructions right there. And yes, then for anybody that's interested in gathering more information about potentially committing, investing in our funds, obviously reach out to me directly.
What's the time frame to close on Fund 5?
Yeah, so it's a fairly tight window. We are going to have a first close in early December, so a few weeks from now. And the end of fundraising will be January or February. So really just about a 3-month period here with the holidays in the middle.
Yep. And 30 million is the number. Yeah.
Yep, exactly.
Yeah. And 50% invested and then draw down from there over the next 18 months, right?
Yes. So if the initial commitment, roughly 40 to 50% will be called at our first close, the balance will be called in roughly 3 equal capital calls every 6 months.
Yeah. Super. Well, once again, you've made it very, very clear. And I will also say once again that Jeff and I are not giving tax advice. So
yeah,
your own research on
the
Cupid thing or however it's called. And we'll make sure everybody's in touch with each other here. And like I said, we'll post this. And
yeah.
Jeff, as usual, excellent job. Thank you again for being here.
Thank you everyone for joining. Thanks, Arthur. And look forward to talking to you again, Arthur.
Hey, let's see, I think we have another question here.
Okay.
Oh, just to thank you. Yep, you're welcome, Anthony. So, okay, till next time. Thank you all for being
everybody.
here.
Bye-bye.
Sharing the only thing you can't make more of, and that's your time. Thank you.